I don't want to drive oil prices up to $100 a barrel or $150 a barrel because I'm driving them down. If you look at oil prices, they've come down very substantially over the last couple of months. That's because of me, because you have a monopoly called OPEC. And I don't like that monopoly.
President Trump wants to break OPEC's hold on oil prices. Now reports this morning that Saudi Arabia is leading a possible cut in production by OPEC because prices have plummeted, down 20% in a month. The news sending oil prices higher this morning, despite entering bear market territory just last week. Oil now at $60.59 a barrel. Joining us right now is the Schork report publisher, Stephen Schork. Stephen, good to see you this morning. Thanks so much for joining us. Your thoughts on this bear market now in oil and what's taking place this morning on these reports of a potential production cut?
Right, Maria. And as you just said, that oil prices have come off 20% over about the last 4 or 5 weeks. But we have to keep in mind that oil prices rallied 20% from the end of the summer up through September. So we had already gone through the peak demand season, and oil rallied 20%. And we were rallying as refineries were going into their maintenance season. So you have to ask, if the refiners were buying fewer barrels, who was buying this market to drive it up 20%? And that was purely speculation ahead of the Iranian sanctions. So we were in a speculative bubble. That bubble has popped. So we're now down to a level where we were right before the bubble inflated at the end of the demand season. So we are clearly now searching for a bottom, Maria, with oil prices here in the U.S. in the low 60s. If you are a quantitative trader, as most of the oil traders on Wall Street are, then you're looking at support between here, low 60s, into the mid 50s. Yeah. But as we look ahead now, we're looking at demand picking up as refineries come out of their maintenance season. They'll be buying more crude oil, and we'll be going into the demand season as the holidays pick up. So we're searching the bottom right here.
Steve Forbes, let me get your take on this. Do you think that this 20% sell-off in the price of oil is reflecting a slowing global economy?
No, I think Stephen is right on that, and I'd like to get his thoughts. Is this $60 range you indicated is the new kind of the normal, that between 55 and 65 seemed to be before the summers where oil had kind of settled after the fall off since 2012.
Indeed, and also with when we speak to, we have a number of major producers as clients. We know that their marginal cost of production, we are now approaching that bottom of the market. So it was a very normal market. I'm hesitant to call this a bear market. I think this is more of a retracement back to where we were at the end of the demand season. So we're at a very normal bottom here in that low $60 range. And as demand picks up, I certainly expect to see price
and Stephen,
rebound.
Do you think this range, what is that going to do to drilling and the wildcatters? Is this going to stop them, or are they going to go forward with these kind of prices?
No, and absolutely. And this is what OPEC back in 2014, when everyone assumed OPEC was trying to drive U.S. producers out of the market. No, they were not. They, in fact, did they did the U.S. producer a favor. They did all of the Fed's heavy lifting. So they cleared a lot of excess out of the market. Producers are much more profitable in this range. So we're looking at the rig counts. Rig counts are at the highest level since when? That is to say, since the market bottomed back in 2015. So, no, at this level, I do not expect to see any sort of material pullback in U.S. production. In fact, U.S. production is going like gangbusters, and I certainly expect that to continue.
And that's enough, Stephen. It's Dagan McDowell to offset the oil that has come off the market because of the Iran sanctions? Or has has that oil even come off the market? Has it just? I know that exports have fallen, but.
Right. When you look at the beginning of this summer, the state of Texas, right before we went into the summer, was exporting more oil than it was importing. We lost a significant amount of oil because of an outage at a refinery, at a bitumen upgrader up in Canada, which is a significant source of oil coming into the United States. And we had record demand for oil. And yet, when we look at OPEC supplies in August, OPEC supplies were at a 9-month high as a rebound in production out of Saudi, out of Iraq, Nigeria, so forth, set off the material declines that we saw coming out of Iran and Venezuela, I might add. So certainly we're at an equilibrium now, I believe, in the market.
All right. We will leave it there. Stephen, it's good to see you this morning. Thanks so much.
Thanks, Maria.
Stephen Schork joining us there on oil and the market.